Okay, Assalamualaikum and good day everyone. Okay, this is example of capital budgeting techniques creation. This is from the final exam creation June 2017 on previous Code of Finance BPF 2213. Right, so this is creation 4B, which carries 10 marks. Okay, let's read the creation. Greener Reviews number hard is considering two mutually exclusive projects. Calculate the net present value of both projects and suggest the best project to be proceed if the expected return is at 16%. The forecasted after-tax cash flows are as below. Okay, so we see in table 3 here, the forecasted after-tax cash flows shows that as for Tropica Venue, the first project, it gives the return for 4 years, right? And it is equally 50,000 every year. Okay, and as for Katulistiwa Park, okay, it provide return for 3 years, right? With initial outlay of 150,000. Okay, whereas as for Tropical Venue, the initial outlay is lower. Okay, initial outlay is lower, equal cash flows and return up to 4 years. Okay, as for Katulistiwa Park, higher initial outlay, okay, and the return is only up to 3 years. Okay, if we manually sum up without considering time value of money, so 50,000 per year times 4 years, we will get 200,000. As for Katulistiwa Park, okay, 30 plus 90 plus 100, so this will carry 220,000 within 3 years. So if we ignore time value of money concept, it looks like Katulistiwa Park will have higher earnings, higher returns. All right. However, the initial outlay, as we can see here, is also higher. All right. So let's look on capital budgeting techniques, how it can help us to solve this equation with precise justification of NPV. All right, so from the data given, we look on the important point. So first, on the equation itself. So it mentioned here mutually exclusive. What is mutually exclusive? It is a similar project which make us to make only one best decision. We can choose only one project, right? Because it is mutually exclusive which perform the same function or similar function. Okay, so at period 0 here, 0 means now, okay, we have to spend some amount of money for the project that we call as initial outlay or capital investment. Okay, so you see the figure provided here in bracket means that outflow or outlay. Okay, as for Tropical Venue, all are the same amount, so we note this is annuity. Okay, as for Katulistiwa Park, okay, initial outlay is higher. Okay, the amount is different for the 3 years, so this is lump sum case, right? Lump sum case, and on the 4th year, no return or no earnings here, so this is actually 0. All right, so since this is annuity for Tropical Venue is even cash flow, so we will use formula of even cash flow. And as for Katulistiwa Park, it is lump sum, so we are using uneven cash flows formula. All right, so first we look on Tropical Venue, the first project, which is even cash flow. All right, the general formula for NPV is total sum of PV cash flows minus with initial investment. All right, so since Tropical Venue, it is annuity case, so we can use the direct formula here. Okay, the A times PVIFA IN. Okay, I 16% and for 4 years. We refer to PVIFA table. Okay, the interest factor is 2.7982. All right, so times with our A 50,000. So this will be the sum PV of cash flows. So if we direct calculate 50,000 times 4 is 200,000, right? However, with 16% return, okay, so the sum present value of cash flow is only 139,910. Right. So deduct with the initial outlay, okay, the project capital invested 130,000. So the excess of fund is 9,910. So the answer is positive, okay, because some PV of cash flow is larger than the initial outlay. So we have profit for Tropical Venue project. Okay, let's look on Khatulistiwa Park. Okay, Khatulistiwa Park, it is lump sum case, uneven cash flows. So we have to outline all the year's lump sum amount. Okay, as for the project, just now it's only earned up to 3 years. So we have 30, 90, and 100,000 for year 1, 2, and 3 respectively. Okay, we refer to PVIF table. Okay, PVIF, okay, different table from Tropica Venue example just now, PVIF table at 16%. And we see here the interest factor we have to write one by one, okay, for the all years incurred. All right, then we use the interest factor that we got from the table times with the cash flow, and we get the present value for each year. All right, then we sum up all the PV for each year, we get the sum PV of cash flows, sum present value of cash flows. Right, so in this case, Khatulistiwa Park earns 156821, okay, throughout the 3 years of return. Deduct with the initial outlay of the project 150,000. Okay, the project brings excess of 6,821 ringgit of profit. Okay, if we compare these two projects, okay, both are actually provide positive NPV. Okay, so if it's an independence project, we can choose both. We can proceed both. However, the equation given just now with the condition, it is mutually exclusive. What does it mean, mutually exclusive? So it means that the decision should be only one, okay, which we should choose the best. If for NPV, we want the highest. Okay, as for payback period, we want the shortest. Okay, so for NPV, okay, here both project provides positive NPV. However, mutually exclusive project can proceed with one project only. Hence, okay, your recommendation should be here, should choose NPV Tropica Venue due to highest profit justified by highest NPV. Okay, these are the 3 important elements that will give marks to your answer. Okay, which project you choose, okay, why you choose that, and what are the tools specifically that represent your reason or your justification here. Okay, so let's proceed or extend the question. If based on payback period, will the decision be the same? Okay, so as for payback period, these are the formula, 2 different formulas. If for NPV just now, we see that we have also different formula when we want to calculate in the table, which one we refer to the annuity table, and another one, the Khatulistiwa, it is lump sum case, right? Which we have to outline each year's PVIF. So as for payback period, we don't use time value of money concept applied to payback period. However, we have different formula. Okay, for even cash flows, the formula is initial outlay divided by cash flow after tax. Okay, and as for uneven cash flows, okay, which every year the cash flow is different. So the formula would be the year before full recovery of the initial outlay plus with unrecovered costs, okay, during that particular year that before recovery, and the cash flow on the divide by cash flow on the following year. Okay, let's look how it be applied. Okay, as for Tropical Venue, just now it is annuity case, so we directly take the IO, initial outlay, divided by cash flow after tax. So 130,000 divided by 50,000, we get answer 2.6 years. All right, however, as in your answer, please make sure you remain at least 2 decimal place. So in this case, we have to write 2.60 years. Okay, we look on Khatulistiwa Park, the next project. This is lump sum case. It is uneven cash flows. Right, so we apply the other formula. Right, so as for Khatulistiwa Park project, just now we have a cash flow of 90, 30, and 100, is it? 30, 90, and 100. right? So we during the first 2 years, okay, if we take 3, that means it's already exceed. So we take 2 years. Okay, at 2 years, the cash flow is actually 120,000. So it is before unrecovered cost is 30,000. Okay, insufficient of 30,000 ringgit. All right, and divide by the cash flow on the third year. So cash flow on the third year, the following year is 150,000. Okay, so it is 2.20 years. Okay, suppose 2 decimal place, right? So this is example which is the answer is not so accurate because it is less than 2 decimal place. So in your answer, please make sure that you write 2 decimal place, 2.20 years. Okay, now let's compare 2.60 years versus 2.20 years. So which one is better? Okay, as for payback period, okay, we want shorter. All right, so back to the question. If based on payback period, will the decision be the same? Okay, so we answer based on payback period, the decision will be different as Katulistiwa Park project is better because shorter time for break even justified by shorter payback period. Means that it only takes 2 years and 2.2 years, okay, in order to be break even. So the company can use the initial outlay or initial capital for other project faster as compared to tropical venue project. Okay, so as for conclusion, what we can say from this? Okay, so in this question just now, we calculate the CBT using 2 techniques, NPV and also PP. As for tropical venue, the first project, we see that NPV, so we prefer tropical venue. Okay, as for payback period, we prefer Katulistiwa Park as it provides shorter payback period. So as for conclusion, we should choose tropical venue because of higher NPV, which means higher profit earnings from proceeding of the project. Okay, so I put note here, NPV is always a preferred capital budgeting tools for making decision. So if we have other tools, usually the company would choose based on NPV, okay, instead of other tools. However, other tools have its own function and it has its own justification. So it depends on the management actually. Okay, so if they concern more on timing to get back their capital, so they should based on payback period. So if it is just general, no specific condition, okay, on making decision, so we choose based on NPV. Okay, so that's it for our discussion on capital budgeting techniques calculation. All right, see you next time. Thank you.